Long before the modern world thought in terms of GDP, inflation, or quantitative easing, banking was simple. A banker stored your gold, charged a fee, and provided security. That was it. But somewhere in the 1600s, something quietly shifted. Governments needed money for wars. Wars they couldn't afford. Wars too politically unpopular to tax citizens for. Bankers saw an opportunity instead of storing wealth. They began creating it on paper, through loans that didn't fully exist. And when governments needed more money, bankers provided it, at interest. This was the birth of debt-based monetary systems. And once debt became the fuel of nations, one rule emerged. The more instability, the more borrowing. The more borrowing, the more profit. This wasn't conspiracy. This was incentive. A structure where global chaos became a business model. Fast forward to the late 1800s and early 1900s, industrialization was exploding. Empires were growing. Nations needed credit to expand, fight wars, and rebuild. Through each boom and bust, something fascinating happened. Banks became too essential to fail, and too influential to regulate. When markets overheated, banks tightened credit, and markets collapsed. Banks bought assets for pennies. When governments struggled, banks extended loans with political strings attached. This wasn't a mistake, it was a loop. Instability gives borrowing, gives bailouts, gives power. By the time the Federal Reserve was created in 1913, the pattern was unmistakable. Banks helped create risk. Risk led to crisis. Crisis demanded government intervention. Government intervention protected banks. And banks emerged stronger. Every single time. The Great Depression. Bank failures consolidated power into fewer hands. World War II. Massive government borrowing entrenched central banks permanently. The 1971 abandonment of the gold standard. Suddenly, money could be created without limit. And debt could grow forever. Debt turned from a burden to a commodity. Crisis became the machine that kept it flowing. Enter the modern era. Global markets were now interconnected. Banks owned stakes in governments, corporations, and each other. Derivatives linked entire economies. A crash in one country could ripple through the world in seconds. And somewhere along the way, the financial system learned a new trick. It could manufacture its own necessary crises. Not intentionally, not with cartoonish villainy, but through a complex cocktail of incentives. Risky lending brings short-term profit. Short-term profit boosts bonuses. When the risk explodes, taxpayers bail out the system. This wasn't an accident. This was design. And then came 2008, a crisis so large it nearly collapsed civilization's financial architecture. A crisis caused by irresponsible lending, fraudulent ratings, and reckless speculation. And yet, the banks responsible were rescued. Their losses were socialized. Their bonuses returned. Their power doubled. How? Because the system had evolved into something unstoppable. The bigger the crisis, the bigger the reward. It wasn't a glitch. It was the math. After 2008, regulators promised reform. But instead of reducing risk, they just moved it. Debt tripled. Derivatives grew even larger. Banking giants consolidated into megagiants. Shadow banking, unregulated finance surpassed $200 trillion. And when the world shut down in 2020, the outcome was identical. Markets crashed. Panic spread. Governments bailed out corporations and banks. Wealth flowed upward faster than any moment in history. By 2024, the top financial institutions reported record profits. During a period of global instability, inflation, and hardship. Let that sink in. The worse the economy performs, the more profitable the system becomes for the top. This is not capitalism. This is not free markets. This is a self-feeding loop of engineered instability. Over the past century, every attempt to fix this machine has failed. Not because policymakers are incompetent, but because they're outmatched. Here's why reforms don't stick. 1. The system rewards risk. Higher risk equals higher return, till the crash, which taxpayers absorb. 2. Regulations chase old problems. By the time laws pass, banks have already engineered new loopholes. 3. Governments need banks more than banks need governments. Political survival depends on borrowing. Borrowing depends on banking. 4. Crisis is profitable. Why would you eliminate the most lucrative part of your business? Even when central banks warn of instability, their primary tool is more debt. Lower rates gives more borrowing gives more dependence. More dependence gives more vulnerability gives more crisis gives more profit. It's a loop without a natural endpoint. Unless something breaks, look at the world today. Global debt, over $330 trillion derivatives exposure, estimated at $1 quadrillion. Top banks profit, near all-time highs. Despite global downturns, wealth inequality, highest in recorded history, middle-class collapse, rapid and accelerating. Nations near default, dozens, including major economies, and here's the eerie part. Every spike in global suffering an equal spike in banking profits. Pandemics, wars, recessions, supply chain breakdowns, currency collapses. To the system, these aren't tragedies. They're opportunities. This isn't conspiracy theory. It's financial physics. Money flows where incentives lead it. 3 takeaways. Crisis isn't a flaw in the banking system. It's a feature. The structure itself turns instability into profit. Debt has replaced money as the real currency of global power. Whoever controls debt controls nations. Reforms fail because they don't address incentives. As long as risk is rewarded, crises will repeat. We are entering an era where global shocks, economic, political, and technological, are increasing in frequency. And unless the underlying incentives change, each crisis will widen the gap between those who suffer and those who profit. The system isn't slowing down, it's accelerating. If you want more deep dives into hidden financial mechanisms, economic paradoxes, and the secret architecture behind global money, subscribe, share this video, and turn on notifications. There's a lot more they don't want you to understand. We're just getting started.